Who you choose to be is the thing that anchors your portfolio.
Returns do not protect you in a storm. Structure protects you in a storm. Even profits. Profits don't come from hope. Profits come from structure and intention. I spent several years making sure that every single one of my investors was made whole. Every vendor, every employee, every single person to whom I owed money, I made sure that I paid them back and I made them whole. I don't fall in love with the deals. I fall in love with the numbers. It only becomes failure if you don't learn from it and do something about it.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. Hey you, this is Christina Suter with Real Estate Breakthrough, and I have Paige Panzarello with me, and she has been my friend. She's been my associate. We've known each other over a decade. I've invested with her in the past. We continue to work together on what we can create moving forward. As a matter of fact, she's like, hey, after this call, can we have a conversation about this thing we want to do maybe together? So that's how close Paige and I continue to work together. And it's always exciting to me when I get to bring on such a close personal friend to me, because we talk about our personal lives too. We're girls. We talk about our personal lives. We go to conferences and we hang out on beds and have conversations.
Those are the best times ever.
Aren't they the best time ever? They're the best time ever. They're so good. They're like, oh my God, tell me about your husband. Tell me about this husband. Tell me about ex-husband. Tell me about current husband. Tell me about it. Whatever it is. But we do enjoy that and we have a really good time with it. But now I get the pleasure of bringing her to my show as an expert in her field. So Paige, welcome to the show.
Christina, thank you so much for having me on. I, as you know, love and adore you, and I love your community. So I'm very blessed to be here. Thank you.
Thank you. I love having you in my community as well. And I appreciate it deeply. So, Paige, you have, like me and like so many investors that have a long history in real estate, you have a little bit of a wandering background in real estate. So why don't you tell us a little bit of the bottom line of how you kind of got from, in your late teens, which is where your story starts, like mine, to today. The problem is I only have 30 minutes for the entire show, so you're going to have to keep...
I'm going to keep it super short.
Keep it super short.
Super short. Okay, fair enough. Yeah, like you said, Christina, I've been in real estate for over 30 years, and I didn't choose it. It chose me. I ended up getting into real estate by default. My grandmother had a very large estate. She passed away, had a very large estate that had some assets in real estate, both in California and Arizona. I went to Arizona and I knew nothing about real estate. And I was willing to be uneasy and ask questions of the people that had the answers. And I very quickly learned that I had a really great head for this. I fell in love with real estate at that time. I grew my portfolio to not only and the estate was in debt. I brought it out of debt in a very short period of time. And I was able to leverage those assets, sell those off, and create my own portfolio and build on that to create a tremendous portfolio over the course of a period of a few years. And I grew very, very fast. So that's kind of how the very thumbnail version of how I got into real estate investing. Yeah.
So we'll save it for a little bit later, but I know we have our ups and downs, and we'll talk about downs a little bit later in the show. Because I think that's equally as important in our real estate history as the successes that we've created. Not to focus on the negative, guys, but really to understand that there is a flow in life and in real estate and in your personal growth and who you choose to be. And ultimately, who you choose to be is the thing that anchors your portfolio, not the portfolio itself.
Yes.
It's who you choose to be that anchors the portfolio. So tell us a little bit about what you're doing today. So you started more in residential, but today you are...
I also still focus on residential. I'm just a lot more structured and a lot more disciplined. And I know that we're going to talk about that a little bit, and kind of what got us to our disciplines and where we are. But I focus mostly, I have started a fund called the Trillion Group. And the fund focuses on two main real estate assets. One is distressed non-performing mortgage notes, where the borrower has stopped paying. I'm very community oriented, and I like to help people, and I like to make money while helping people. So that is a really easy fit for me and the portfolio. And then I'm also known as the cash flow chick. So I focus on the fund also buys self-storage facilities across the country that are maybe underperforming, underutilized. We've got some tired mom and pop operators. So we focus on depreciating assets that cash flow as, like I said, self-storage. And then we also have distressed mortgage notes. Those are the two main focuses that I'm currently involved in.
Okay. And I think it's interesting to me. Hold on a second. Sorry. It is interesting to me that you have moved kind of consciously and intentionally from doing the notes to doing storage. And I think that's a sign of our times as much as it's just a sign of your own development. Like we all develop as real estate investors, and over time we get bigger and stronger, and we can handle more complex assets, and we set up more complex structures like a fund because we've gotten the experience to be able to manage that level of complexity in our portfolio and in what we do with other people's money. But you've intentionally moved over to storage as well. So give me a little bit of understanding of purely cash flow chick is now, she now does two different asset classes. And what was in that decision?
Again, I wanted a balance. As you know, mortgage notes are a year-round, 100% of the time, not subject to what the market is doing, which is fantastic. Because everybody, most people like to live in a house, right? They don't, they don't prefer to live in a box somewhere or under an overpass. So mortgage notes are always going to be involved in our culture, in our market cycle, et cetera. When we have, however, market cycles where values become overinflated for properties, pricing and the margins get a little thinner when you're dealing strictly with mortgage notes. So I wanted to be able for my investors and myself to have not one, but two vehicles that can generate cash flow that will hedge against it will hedge against whatever market cycle we're in. Also, Americans that are in distress for their homes sometimes will downsize and try and look for a smaller place, but we don't get rid of our stuff. And so they needed a place to put that. So it was a really great progression for me. And I've been involved in self-storage before in my, way back when. And times were very different. Technology has come into the marketplace for self-storage as well, which was a key point that I needed, because the days of having a manager sit in an office waiting for people to walk through the door to rent a storage unit are gone. Now everything is automated. We can use third-party vendors to manage remotely. And so that was a perfect fit, not only for the cash flow aspect, but for the time and the management aspect as well, not only for me, but for my investors through the Trillion Group.
And to me, I think it's a very good process, or a very good breakout between the two, because, the performing notes, although you say they're pretty much always available, and they are always available, there is some cyclicalness as to when more are available versus less are available. Whereas storage is beautiful because it's always available, and it goes up when the economy is going down. And it also can have some bumps even when the economy is going up, although I don't know all that beautifully well. I'm not a storage unit owner or GP, right? But I do know that it can all of a sudden get life, in non-cyclical times. So it's consistent. I every time I talk storage, I have to confess, I have 4 storage units. I am your prime client. I have 4 storage units. I have my seasonal stuff that I rotate through, that is my organized unit. I have my mother's stuff. I have my grandmother's stuff. I have the second house stuff. I have 4 storage units full of stuff.
And you've probably had that for years. And you know what? I am an operator, and I do own facilities, and I am also guilty of renting a storage unit here in California, which I'm very tempted to take my stuff here in California and have it shipped to one of my facilities elsewhere, because the rent, especially here in California, is a lot higher than in other parts of the country. So don't feel badly, Christina, because I am also guilty. Now I don't have 4, I only have 1, but yes, I'm also guilty.
I have 4. I confess I have 4. I am your client. It is true. It is true. And I think, but again, I'm a really good example, right? Like you yes. highlighted immediately, like, and you've had them a long time. Yeah. My mom passed in 2014. I still have my storage unit full of my mom's stuff that we pulled out of her house from 2014.
Okay. Right? So 12 years.
12 years.
There you go.
Storage unit for 12 years. So, and I think that's just accurate, right? There are people like me who never give it. I have no anticipation of not having storage units, or yes. not having at least one storage unit.
Yes.
Right. Like
most of my tenants have been there at least 3 years or more. Yeah. Most of them, 90%.
90%. I'm not overly surprised. And the reason why I'm highlighting this because I think it gives our listeners an opportunity of why storage is sort of in some ways the newer baby, right? The newer favorite baby, right? Like we went from multifamily being the favorite baby to mobile home parks being the favorite baby to storage being the favorite baby. And the reason why the favorite baby is important is because how professional are the people who are running these units? Because it's an immediate value add for an operator like you, who, mm-hmm. like you said, had some history in your past, who now understands what it is currently, who is aware of the current tech that has changed the industry and how it performs, to come in and say, hey, somebody who's owned that for 20 years and still has somebody sitting at the front desk, right, and therefore has no access outside of front desk hours because they don't have electronic systems that allows them to do that, or whatever mm-hmm. they're missing in their systems. You can immediately put efficiency of management in place that immediately makes it more valuable.
Exactly.
Right? And it really has to do with how percentage of the field is owned by mom and pop operators versus people who have the background you do. So tell me a little bit about the storage field and why, about that concept in the storage field. Who owns what? How good are they? What's available for you?
It's very interesting because there's it goes from extremes in both directions, right? There's the highly efficient primary markets, big REITs that have, hundreds of thousands of square foot under management, mm-hmm. to the very small tertiary markets, mom and pop that have been doing this for 25 years. They don't want to answer the phone anymore. They don't even have a website.
Right, they don't have a website. Thank you.
As a matter of fact, a recent purchase, the facility owner was answering his own phone and did not have a website at all. Right. He did try and implement some technology, so it wasn't completely like Excel spreadsheets and hand and paper, but it was very nominal, and just not equipped. And he didn't realize he bought it, he didn't start it, but he didn't realize that this is an actual business. There's a lot that goes into the actual business, and he decided, I'm too old, I don't want to do this. So that's kind of the marketplace. I focus on secondary and tertiary markets. I tend to shy away from the primary markets. I'm not a big REIT. The Trillion Group Fund is a smaller fund. Mm-hmm. We don't have hundreds of millions of dollars to go out and deploy in primary markets, and undercut people that are trying to find a good deal. Mm-hmm. So that's not my sweet spot. My sweet spot is more the secondary and tertiary markets, especially tertiary markets that are in the path of growth. I pay attention to those things. Where is AT&T going? What, infrastructure, where are the opportunity zones that are headed toward the path of progress? And those are the areas that I look to. There's a lot less competition. There's a low entry point, a low entry barrier that mm-hmm. right there. So I'm not going to combat that. There's a whole lot less competition. Usually the square foot availability per capita is significantly lower. So we don't have oversaturated markets. So that's kind of the landscape of where I'm looking. And then there are certain states that I don't invest in because they're, it just doesn't make sense in terms of the numbers. I try and provide my investors with a better return, obviously being intentional and very structural about how I present and underwrite my deal. But that's what I go for. I don't go for, and it has to cash flow. So
yes,
those things.
Exactly. Especially with the secret sauce of your company, right? Like you're starting to describe now, like why Trillion Group works really well is because you're actually focused on the secondary and tertiary markets. That's one of your secret sauces. Right?
Yeah. And here's a big point about the secret sauce, and any of your listeners, especially if they're entrepreneurs that are looking to source, you need to you definitely need to vet your sponsors. And there are a lot of sponsors that are out there that flash huge returns, potential, things like that. And I want to say this is my secret sauce, is that returns do not protect you in a storm. Structure protects you in a storm. Okay. And profits don't come from hope. Profits come from structure and intention. So I don't chase deals. I don't chase returns. I like them and I underwrite to them, but the numbers have to work, because if they don't, then I don't do the deal. I don't fall in love with the deals. I fall in love with the numbers. And that's my secret sauce and what makes me successful and my investors successful.
Well, and it's also, I happen to know the secret sauce of your notes business as well. Right?
Yes.
It's the same thing.
Same thing.
What's the structure behind it? Do the numbers make sense? Yeah, it's not performing right now, but
exactly.
At what point, with what percentage, how is that going to work, and can I get it to reperform? What are the chances of it reperforming? And being able to use that structure of understanding.
Exactly.
Right, back down to the numbers. So
exactly.
It's kind of like, let's double back a little bit to like your history, because part of what is the secret sauce of your company is the history that you've lived through, that I've lived through, that makes us, and it's very important, because a lot of people can say, numbers, I stretch the numbers. We all know it's in the numbers. A lot of people can say that, but the history and the flesh and blood of that is really, I think, what, puts the integrity behind the statement.
It absolutely does.
So tell us a little bit about something that didn't go right in your history and what you did to solve it. Because honestly, as long as you're still in real estate, you did something to solve it, right? And there's a growth curve that occurs in that solving.
There definitely is. So there are a couple different parts to your question. Hopefully I can answer it fluidly.
Basically, tell me the story. Tell me how it grew you. That's all.
Yeah. Okay. So fair enough. And as you know, Christina, I mean, when I first started, I didn't know what I was doing. And again, I was okay with being uneasy and asking those questions, but I wasn't always this clear. And I certainly wasn't always this disciplined. I just kind of got thrown into the deep end of the pool, and I just threw the spaghetti against the wall and figured out, okay, maybe this will stick. Now that's completely different because of what happened, right? So I was in 2007, 2008, I was in the thick of it, right? I had a portfolio that looked tremendous on paper. But the world changed, as you know, in 2008. And that year, through no fault of my own, just because the world had changed and I didn't have much of the structure in place, that year I lost $20 million.
Yeah, I thought my number was tough. When I heard your number, I was like, oh my gosh.
Yeah.
Wow. I felt like I had to crawl my way back from the 2 million plus that I lost, right? Like, oh my God, I've lost so much money. And you're like, whoa. I'm like, okay, babe, that's a learning curve. Go ahead.
And you know what? Loss is loss. It doesn't matter if it's $2,000, $2 million, $20 million. Loss is loss. It only becomes failure if you don't learn from it and do something about it, right? So for me, that number, it's not just a number. It represents sleepless nights, right? A crushing weight of responsibility. but here's the part that I did to fix it, right? That's the thing that I'm the most proud of, is that I didn't take the easy way out. I fire sold everything I owned, and I had quite a bit. But I spent several years making sure that every single one of my investors was made whole. Every vendor, every employee, every single person to whom I owed money, I made sure that I paid them back and I made them whole. And I did that at great personal sacrifice. And that is a decision that I would still make today. If that, God forbid, ever happened again, that is a decision I would make today. But, after that, I then rebuilt my career, and I rebuilt it on a foundation of total clarity, right? I learned the hard way that as I said earlier, returns do not protect you in the storm. It's the structure that protects you in the storm. And today I'm very fortunate because I am again working with investors through the Trillion Group, and we acquire assets through the country. And I'm much better for it. I'm much better for it because now I have clarity of vision. I know exactly what I'm doing. I know what I target. And that includes investors as well. I don't take every investor that knocks on my door. And that's really important because that's for my own personal integrity and the integrity of my community. So yeah, that's kind of my background and what shaped me and what gave me my risk tolerances, what I need, want, like, desire, how I want to operate, not only in the world, but in business, and how I want to protect my downside and the downside of my investors.
Beautifully said. Beautifully said. All right. So moving forward, I'm going to timestamp this. This is 2026. Right,
yes.
2026, and we try not to timestamp podcasts very often, but we're going to be talking specifically about what do you think is coming up specifically in the economy and your industry.
Yeah.
You can talk about either one you want, whether it's notes or not, or storage or not. Let's talk about what do you think is coming up, because I think that's a topic, a pretty hot topic right now. Like, are we going to go another year? Are we not going to go another year? I'm in multifamily, so we're talking about it all the time. Like,
yeah, of course.
Is multifamily going to bump along the bottom before it starts to recover?
Exactly. And I'm going to talk a little bit about both. So self-storage, interestingly enough, we are seeing more and more deals that are coming to market. And you have to dig because, if you want the returns and the protections and to find those, you have those little nuggets, you have to dig. So it's a numbers game. But we are seeing more and more that are coming to market, which has been a challenge, believe it or not. There were a lot of people that were buying self-storage facilities like crazy between 2020 and 2022. They were overpaying and they had no idea, because interest rates were super low, things like that. They had no idea because they just figured, okay, you just plop somebody in there and collect the money. But there's a lot more that goes into it. So interestingly enough, a lot of those and commercial loans, Christina, as you know, are sometimes 3 to 5 years. Yep. So here we are kind of on the brink that people are now having to refi those loans because they've got a balloon payment that's due, or they just misjudged. And so we are seeing more of the self-storage facilities that are coming to market. The last, I'm going to say 6 months or so, pricing has been a little higher than I like. But again, you dig and you make offers and you state your case and you back it up, right? With cold hard facts. Because I underwrite to today's deal, right? I underwrite to today's numbers, not future prospects. I don't underwrite based on pro forma. I underwrite to today's numbers. Okay. So that's self-storage. There are more opportunities that are coming, which are great. In terms of distressed mortgage note, the opportunity is far greater. We are seeing numbers. Month over month, I've been watching, and we are seeing double-digit increases, month after month after month after month, and to the likes of which, the bad debt is looking very similar to 2008. And I've been waiting for this. I've been blowing this horn for the last several years.
Yeah.
The
This
government.
is going to be coming at us. Yep.
Yep. The government did some things during COVID that kind of kicked the can down the road and stabilized some things. So we didn't have a complete crash, but I'm seeing what's happening. And the reason that, in my opinion, the interest rates aren't dropping is because it's going to throw us back into hyperinflation and a few other things. And as you know, the big topic right now is the affordability crisis, right? Mm-hmm. So more and more people are defaulting on their loans. A lot of people in COVID went into a forbearance agreement. Yes. And some of them were in what's called a 5-in-1 ARM, which means that they were at a fixed rate, very low fixed rate for the first 5 years, and then it converted to an adjustable rate mortgage, which is right now, which is exactly what happened in 2008, as you know. Right. So right now, a lot of those foreclosures that we're seeing are those forbearance agreements that have converted into a fixed rate. And as we are in higher interest rates, and those people have not the best credit because, they stopped paying their mortgage for a little bit. So now they're really in over their head. So we're seeing a tremendous amount of opportunity coming. I think we're going to see more foreclosure starts, but I think more are coming. I think by the end of this year, we're really going to start to see a flood. And by the middle of next year, I think we're going to be looking in the past looking glass and mirroring to 2008. I think we're going to come close. I don't think we're going to drop off the cliff like we did. Yeah. Because, we learned, but
single family in particular, but definitely not.
Single family in particular. Yeah. But I do believe that there's a lot more opportunity that's coming.
Beautifully said. All right. I'm afraid that brings us to just about the end of our time.
Oh my gosh, that went fast.
It's already been 26 minutes. Hard to believe, but it has been. So let's make sure that people can get to you. What's your information? How do they get a hold of you? How does that work?
Yes.
Give us the lowdown.
Okay, so they have a couple of different things. They can scan that QR code right now and book a call directly with me on my calendar. That's the easy peasy way to do it. You can also go to askcashflowchick.com, and that will also take you directly to my calendar. And you can book a free call with me. It doesn't cost you anything. I'd love to talk with you. You can go to the Trillion Group, which is TRYLLION group, and send an email that way as well. But the easiest thing is really to book a call directly on my calendar.
Yeah. And I always believe in eyeball to eyeball and, eyeball and belly to belly. I think it was Mick Blackwell who used to say that. Mick used to say that, eyeball to eyeball and belly to belly. So
Yes.
And, since you know Mick, you also know he had a bit of a belly. So he may literally have meant belly to belly. But,
belly to belly, exactly.
He'd be right there with you, baby. All right, let's talk. Right? And he'd have this great belly, But it's good. It's good. It's good because I think that still holds true in real estate, in investing, especially if you're going to be an LP investor. You do want to take that moment to truly understand who your sponsor is.
Yes.
The structure, as you repeated so many times. So I think that there's some deep lessons in this, guys, so make sure you listen to it more than once. This is Christina Suter with Real Estate Breakthroughs. So glad to have you guys listening to my show. You will find the next upload in 2 weeks. And I thank you, Paige. Appreciate you showing up and giving us some good information.
Thank you, Christina, for having me. I really appreciate it, and I loved being here.
Yay.